Ever feel like the stock market's speaking its own, I don't know, secret language?
Ha, yeah, it definitely can seem that way sometimes.
Well, today we're trying to crack just a tiny piece of that code.
Yeah.
We're looking at how newer traders might think about when to actually buy a stock.
Right. We've been digging into some advice from Miss Mancy on this.
Exactly. And our mission really is just to pull out the practical, actionable stuff she suggests about finding good entry points.
Make it clear, make it usable, no matter your experience level.
So she outlines 3 specific ways to consider buying. That's our focus today.
That's it. Buying at breakout, buying at support, and then there's buying in an extremely oversold condition.
Okay, let's kick things off with that first one.
Yeah.
Buying at breakout. What does that actually look like on a chart?
So imagine a stock's price has been moving kind of sideways for a bit. That's consolidation.
Uh-huh.
Buying at breakout means you jump in after the price makes a strong move above that sideways range.
Okay. And is there anything specific that makes a breakout seem, well, safer or more reliable, according to this advice?
Yeah, the suggestion is to look for that breakout after the price is consolidated for at least 3 candles, maybe more.
3 candles, like 3 trading days if you're looking at a daily chart.
Could be days, could be hours, depends on your time frame. But yeah, at least 3 periods showing that sideways movement. And actually, the advice says more consolidation is often better.
More is better. Okay.
Right.
Any other key conditions?
Oh, absolutely. Crucially, the stock's price really should be above its 200-day simple moving average.
Ah, the 200-day. So looking for stocks already in a longer-term uptrend.
Exactly. It gives you that context.
Yeah.
And there's also a preference mentioned for the ADX indicator.
ADX,
Right.
right, that measures trend strength.
Yes. The advice leans towards wanting the ADX to be above 25. Suggests there's some real momentum, some oomph behind the move already.
Got it. Now, you mentioned something vital for all these methods.
Volume confirmation. Cannot stress this enough. It's mentioned as absolutely key for all 3 entry types.
So when that breakout happens, you need to see more people actually trading it.
Precisely. A noticeable jump in trading volume. It helps confirm there's real conviction behind the price move, helps avoid those false breakouts.
Right, where it pops up and then just fades immediately. Makes sense. Okay, method 2, buying at support. What's the thinking here?
This is about finding price levels where the stock has, historically bounced back up from before.
Like a floor the price keeps hitting and then reversing?
Sort of, yeah. The idea is maybe history repeats and buyers might step in again at that same level.
And are there specific signals we look for right at that support level?
Well, the advice points towards seeing a bullish candlestick pattern form right there.
Bullish candle, okay. Like what kind?
Could be a bullish engulfing. That's where a big up candle completely swamps the previous down candle. Or a hammer pattern.
The one that looks like a T?
That's the one. It suggests sellers tried to push it down, but buyers came back strong. These patterns hint that buying pressure might be returning.
Okay, so we spot a hammer at support, buy right then.
Not quite yet. The advice is pretty specific. Only trigger the buy if the price moves above the high point of that bullish candle.
So confirmation again. Wait for the upward move to actually start.
Exactly. A bit more confirmation.
And how do we even find these support levels in the first place? Any tools mentioned?
Yep, several are suggested. You could use trend lines, moving averages, an indicator called supertrend, or even just drawing basic horizontal lines on your chart where the price has bounced before. Especially useful if the stock's just trading sideways.
And those other conditions, did they apply here too, like the 200-day average?
Yes, same deal. Ideally, the stock is above its 200-day moving average. An ADX above 25 is still preferred, suggesting an existing trend.
And volume.
And definitely volume confirmation when you get that buy signal above the bullish candle's high. Non-negotiable.
Okay, clear. Now the last one sounds a bit different. Buying in an extremely oversold condition. You said this is more advanced.
That's right. This one comes with a strong caution flag. It's explicitly mentioned as something only for traders with at least 3 years of experience. It's generally a higher risk play.
Why is it riskier? What does extremely oversold actually imply?
It generally means the stock price has dropped, often very quickly and significantly. Some technical indicators, like the RSI or Relative Strength Index, might signal this when they dip below a certain level, say 30.
Suggesting it's gone down too far, too fast, and might be due for a bounce.
That's the theory. But catching that exact bottom, predicting the bounce point, that's notoriously difficult. You could be trying to catch a falling knife, as they say.
Oof, yeah, not fun. So even for this advanced strategy, is there a safety check?
Volume confirmation again. Even if you think a stock is screamingly oversold, The advice stresses you must see volume come in when the price starts to turn upwards.
So confirmation that buyers are actually stepping in, not just a dead cat bounce.
Exactly. It helps try and distinguish a real potential reversal from just a temporary pause before it heads lower again.
Okay, wow. So three distinct methods there.
Hmm?
Stepping back, what's the big picture message from this advice?
I think the core idea is about having structured approaches. It's not about guessing or trading on gut feelings alone.
Right. It's about waiting for specific clues, specific evidence in the price action and volume.
Precisely. Patience and confirmation seem to be the recurring themes.
And maybe for you listening, this is where it gets interesting. Notice how the same few things keep coming up. The 200-day average
The ADX above 25 preference.
and volume, always volume.
Yeah, it's like these conditions act as filters. They don't guarantee anything. Of course, trading always has risks.
No guarantees, definitely.
But they potentially filter for higher probability setups, situations where the long-term trend, the shorter-term momentum, and actual trading activity are maybe, just maybe, starting to align in your favor.
It gives you something concrete to look for rather than just feeling overwhelmed by charts,
Yeah.
right?
That seems to be the goal, offering a more systematic way to think about entry points.
So thinking about these structured approaches, breakouts, support, even the advanced oversold one, what kind of patience and discipline do you think it really takes to use these effectively, especially when, your own money is on the line?
That's a great question to reflect on. It's one thing to understand it, another to execute it consistently.
Definitely worth considering how this compares to maybe how you approach buying decisions now. Does it offer a new lens, perhaps?
Mm.
Something to think about?